The bottom line is gold is real money. It's gold and silver are the only real money on the planet. Everything else is currency. And if we have a financial meltdown between now and year end, this time around, you get a meltdown like we had back in 2008, 2009, which this time will be a loss of control. And that loss of control will include a failure to deliver by COMEX and LBMA. So we get a failure to deliver, all bets are off as far as price. I mean, you look at that, $5,000 could be a stupid low price.
Global central banks have been snapping up record amounts of gold since the start of 2022, a trend that should continue as countries look to move away from an overconcentration of reserves in the dollar, according to State Street Global Advisors. Monetary authorities across nations made net purchases of 387 metric tons of the yellow metal in the first half of 2023, after buying an unprecedented 1,083 tons last year, the world's fourth largest asset manager said in a recent note. Bill Holter believes central banks are acquiring gold as a hedge against the potential collapse of the Western financial system. Unlike fiat currencies, gold's intrinsic value and lack of liabilities make it an attractive asset for them, independent of government backing or debt obligations. Bill raises concerns about the lack of recent audits of U.S. gold reserves. This opacity regarding the actual quantity of gold on hand raises questions about potential liabilities if the U.S. had to pay its debts using gold. He speculates that in such a scenario, the price of gold could soar, possibly reaching astronomical levels like $125,000 an ounce or even higher. Throughout the 7 crisis periods that have unfolded since 2007, gold has consistently demonstrated its worth as a secure haven asset. On average, across these 7 periods, gold bullion yielded a return of 11.12%, outperforming the S&P 500 Total Return Index, which posted a 13.05% return, and U.S. Treasuries, which returned 3.86%. The current geopolitical and economic turmoil commencing in early 2022 with Russia's invasion of Ukraine and extending into 2023, characterized by the Q1 U.S. banking crisis, has been marked by the adverse effects of increasing interest rates and persistent higher-than-expected inflation on financial markets. As in previous crises, gold has proven its mettle as a secure investment compared to more conventional asset classes. Bill Holter envisions that, in the event of a financial meltdown, the price of gold could potentially surpass $5,000 or more. We will bring you clips from Bill Holter's interview with Soar Financially. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
I mean, all central banks are going to do what's best for them. And I think central banks are looking at what we've just talked about, the mathematics of U.S. sovereign debt and the ability to service it with dollars. I think they're looking at that and saying, well, the U.S. is going to have to seriously debase the dollar in order to keep any sort of game going. So how do central banks insulate themselves from a downturn / collapse of the Western financial system? They buy gold. And again, central banks understand that dollars are fiat. Gold is not fiat. Gold has no liability. And gold is something they can hold on their balance sheet and know that it's still going to be there tomorrow morning. An ounce of gold is an ounce of gold. With Western currencies declining in value, the gold will serve its purpose. I believe the Western financial system is in the process of collapsing. I don't think anyone can forecast a price for gold because first off, you have no idea how much more debt the U.S. is going to pile on. Secondly, nobody knows. There's not been an audit of Fort Knox, West Point, et cetera, since, I think, 1956. So there's no way to know exactly how much gold the U.S. even has. And if you do the math, if the U.S. was required to pay its debt with gold ounces that we supposedly have, the number would be over $125,000 an ounce. And in a collapsed system, and we find out, God forbid, the U.S. does not have the gold that we say we have, pick a number, 500,000, a million, 10 million, who knows? And I mean, you could laugh at it all day long, but look at Weimar Germany. Gold went from 200 Reichmarks to what was the number? 2.7 trillion Reichmarks. The bottom line is gold is real money. It's gold and silver are the only real money on the planet. Everything else is currency. I mean, if we have a financial meltdown between now and year end, yes, in the past we've seen financial meltdowns where you saw the price of gold and silver get hit. That was orchestrated by selling naked contracts. This time around, you get a meltdown like we had back in 2008, 2009, which this time will be a loss of control. And that loss of control will include a failure to deliver by COMEX and LBMA. So we get a failure to deliver, all bets are off as far as price. I mean, you look at it, $5,000 could be a stupid low price. Just look at the movie Rollover. What was the famous line in there? 2,000 an ounce will be cheap by tomorrow morning. And that's when gold was what? 400, 500 bucks an ounce.
In 2023, global debt reached a record $307 trillion, as the Institute of International Finance reported. This was a significant increase from the previous year when it stood at $303 trillion. In 2020, the International Monetary Fund, IMF, noted that global debt had already hit a record of $226 trillion, marking the most substantial one-year surge since World War II. Bill asserts that while global debt continued its upward trajectory, tax revenues, crucial for servicing this debt, did not show similar growth. Instead, they experienced only modest increases over the last 3 years. Before recent changes, the funds allocated for debt servicing, known as debt service, remained stable at $350 to $500 billion annually for approximately 3 decades. This stability was maintained by consistently lowering interest rates to offset the growing debt. However, this equilibrium shifted as interest rates began to rise. Bill observes that rising interest rates started from an extremely low base, near 0%, making even a small increase disruptive to the financial system. He argues that the debt burden has become so enormous that it cannot be serviced or repaid using the current currency terms. A default is seen as inevitable, which could lead to a collapse of currencies. Bill predicts a significant global shift, particularly an East versus West reset, as the debt-based foundation of Western currencies weakens.
Yeah, this is the end game. Debt has gone parabolic, and the ability to service that debt, in other words, tax revenues, have not gone parabolic. They're barely growing. If you go back just 3 years ago, and for the previous 30 years before that, the debt service amount traded generally between 350 billion and 500 billion per year. And that illusion that the debt service was not rising was able to be done by lowering interest rates continually. The debt went up, the interest rates went down, so the debt service stayed the same for roughly, like I said, roughly 30 years, 30 plus years. That illusion basically stopped once interest rates started rising. And the problem is those rates started rising from 0%. And again, coming off of a zero interest rate, for rates to go up 1%, 2%, at this point, over 4 percentage points, because they're coming off of zero, it's completely devastating. It's not like going from 5% to 10%. 0% to 5% is a shock. It will completely shut the system down. If you go back just 6 months ago, you had 4 major banks all fail within 2 weeks or 3 weeks time. And the assets of those 4 banks were greater than all the banks that went under back in 2008, 2009. So the problem's already bigger than it was back then. And they did get it shoved under the rug. But that's rates were 3.25%. Now they're 5%. And we've not even talked about derivatives. All derivatives are issued. Every derivative, when it's issued, is issued with an interest rate assumption. And how many derivatives you think have been issued in the last 6, 7, 10 plus years since the 2008, 2009 episode, how many derivatives have been issued in dollar terms or euro terms or yen terms? How many derivatives have been issued with basically a 0.5% or 1% or 2% assumption, and now we're at 5. So it's off. It's knocking the derivatives sector off center, and that's a $2+ quadrillion market. On top of 400 trillion in debt. There is no solution, and that's why I say this cake is already baked. You can't unbake it. You can't change the shape of it. The cake is already baked. There is no solution because the math cannot be negated. The debt service cannot be, the debt can no longer be serviced, and the debt certainly cannot be repaid in current currency term. For instance, just look at the BRICS. I mean, there's going to be an East versus West reset. There's no question about that. And because all fiat currencies are debt or credit based, once the debt in the West begins to collapse, and the debt is already starting to collapse. And I mean, just looking at the interest rates going up and the bond prices going down, the foundation itself is thinner and thinner. So when the debt collapses, that will ultimately collapse the currencies themselves because they are debt based. And that's why you want to own gold. That's why you want to own silver, because those are the only two monies that cannot bankrupt in a world that's defaulting.
Gold reached a 2-month high on Wednesday due to the escalating Middle East conflict, drawing investors to its safe haven appeal amid uncertainty and geopolitical turmoil. What are your thoughts on the price movements of gold and silver? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.